and many other sectors.
Hello and welcome to Market Masters, our stand-back show for markets where we get you to meet some of the finest brains on the Lal Street who've made phenomenal wealth not only for their clients but also themselves, traveling over different kinds of markets. I am Shailendra Bhatnagar and with me is my co-anchor Sakshi Batra. Our guest today is a special individual. Mr. Ravi Dharamshi joins us. He's the founder and managing director at ValueQuest Investment Advisors, a young man who over the last 2 decades has risen dramatically. Ravi was with us on 28th of August 2023, and between that time, let's look at the progress of how the markets have come in. The reason why I mention this is that it's going to make Ravi's task a lot more difficult between then and now to suggest where markets are going. Ravi, just bear with us for a moment. We'll just take a look at the Nifty. On 28th of August, when Ravi first joined us, and remember he gave a very bullish projection on the Nifty that's borne out rapidly. And one more thing, welcome to a record high everyone, ladies and gentlemen. The market is at a fresh high today. Between then and now, the Nifty has appreciated about 14% to a fresh record high. The task on the Nifty mid-cap index and the small-cap index is even more phenomenal. So the mid-cap index is up somewhere in the vicinity of 27%, again a record high, and the small-cap index is up a whopping 36%. So with this background in mind, Ravi bhai, a very warm welcome to you. And at the moment, Ravi is managing 11,500 crores at ValueQuest, of which 25% is in large caps and 75% is in mid caps. Good afternoon to you, Ravi.
Good
How do
afternoon,
you see the market?
Good afternoon, Shailendra ji. Good afternoon, Sakshi ji, and thank you for having me.
It is always a pleasure to have you, Ravi. It's so good to see young people in the market progressing so well, and you've done a lot of hard work over the last 2 decades, all of it paying back very strongly. How do you see the market at this level? Is it overheated or are we still in equilibrium?
No, I think, markets are very rarely in a state of equilibrium. We are definitely more towards the side of optimism than we are towards the side of negativity. But having said that, just because markets are optimistic doesn't mean markets are going to correct. Just because valuations are on the higher side is not enough reason for the markets to start correcting. The fundamentals and outlook both remain very strong. We have political stability, we have domestic flows, we have foreign flows. Foreign positioning is very poor, which is actually a sign that it's not yet euphoria. A lot of the domestic money that is coming in is going into mid and small cap strategy, which is what is leading to the higher valuation. However, I am not of the camp that believes that there is a bubble in mid and small cap. Maybe in the SME space there could be some sense of bubble, but not in the mid and small cap. Now we get about $2.5 billion kind of SIP flows regularly, and we get another $1.5 billion kind of flows from insurance as well as EPFO. Now, if we are going to have about $3.5–4 billion a month, that's about $45 to $50 billion kind of an annual run rate of money. Roughly about 50% of that goes into mid and small caps. So that's a $20 billion number. That's a big number, and that is what is leading to the rally in the mid and small cap. But as I mentioned earlier, whether it is the global economy or whether it is domestic economy, at this juncture, there is nothing on the horizon which suggests that there could be a sharp correction. There are key events lined up, whether it is Fed pivot, RBI pivot, Indian elections and US elections. These are the 4 major events that are lined up, scheduled events that are lined up this year, and we'll be looking for how they are panning out and what cues we can gather from them.
Okay, so that's the broader theme that Ravi is working with, that mid caps and small caps are still not overvalued. and there is more to be had in terms of wealth creation. Ravi, I was just going through the portfolio that you've shared with us for ValueQuest Platinum. About 1,200 crore rupees is the AUM, and from the date of inception, somewhere in July 2014, the fund has outperformed its inception index by 2 times. So, the value of 1 crore invested in VQ Platinum since inception is now 6.06 crores versus the index where it has grown to 3.5 crores. Now, what are the broad themes that ValueQuest Platinum is addressing at the moment, and where are those sectors or stocks headed over the next 1 year?
Yeah, so just a little bit of what you mentioned. 1 crore invested in ValueQuest Platinum has become 6 crores, and BSE 500 in that meanwhile has given roughly about 3.4 crores kind of a return. So it's almost an alpha of about 7-8% since inception, and that results in almost doubling of wealth in this case. Coming back to your question on what sorry, I would like to address the earlier point as well, that mid and small caps are not expensive. I won't say they are not expensive, but just being expensive is not a good enough reason for the stocks to come down. I do strongly believe that in a rising corporate PAT to GDP cycle which we are in, the breadth of the companies that do well tends to increase in number. And as something that I tweeted 2-3 days back, that the small cap to mid cap, small and mid cap to GDP, the corporate PAT is still at a very low number, 0.7%. So there is still headroom for this profits and profitability to increase. Currently, the growth engines are not yet firing in completely. So there is still enough scope for the growth levers and profits lever to increase from here. So this is not the peak of the mid and small cap cycle, even though they might have moved a step ahead of the market right now. Now, coming to the themes that you asked about, what are the themes that we continue to like? So we are a very thematic oriented investors. We like to find sectors and themes that will do well over a 5-7 year period. We were very bullish on manufacturing about 2.5 years back, and we have capitalized on that by buying into defense, electronic manufacturing, and some railway stocks. So those have panned out very well. We are kind of taking a break from these 3 sectors within manufacturing. We are reducing our weightage over there, but not exiting yet completely, because we still believe that there is a lot of tailwind in these sectors. What we currently like from this point on are financials. Within financials, we like lending as well as non-lending. I think the last year's flavor has been PSU banks have done way better than the private banks. But I think at some point of time in this year, that should reverse as it becomes more and more difficult to gather deposits. The NIM pressure will start showing. So the men will be separated from boys. And a lot of these PSU banks are actually at a 13, 14, 15 times leverage. So they will be coming to the market to raise funds. So both the combination combined, I feel at some point of time, the performance will come back in favor of private banks. Okay. On the lending side itself, there are other pockets, affordable housing, which is doing very well. Some of the small business focused NBFCs are doing very well. On the non-lending side, we like general insurance, we like capital market beneficiaries. So whether it is a discount broker, wealth manager, market infra companies, exchanges, these are all doing very, very well, and we continue to like them. One more theme that we like is energy transition. And within energy transition, we really like the power transmission sector. And in power transmission, we like to focus on equipment suppliers because I believe there is going to be a big capex happening over the next 5-7 years globally in this space. For the energy transition from fossil fuels towards renewables to succeed, we need to first get the transmission capex in line. This is like, we cannot start selling cars unless we have the roads built. So laying out the power transmission is like laying out the road, and then only will we have cars flying on the road. So these are some of the themes that we continue to like, and we believe there is still a lot of money to be made over here.
That's wonderful. We will continue to keep an eye on lending, non-lending spaces, private banks is what you're liking, affordable housing, energy transition, and within that transmission space. And we will continue to focus on all of these. We also have a lot of questions that are coming in for you, Ravi, from our viewers, and we will ask you some of those along the way. Let me just begin with the first one that's come our way from the viewers' questions is from New Delhi. Manish wants to know, how can I identify undervalued stocks or sectors with potential for growth even when the markets are now at record high levels?
So clearly, everything is not doing very well. Markets being at a high does not mean there are always pockets of undervaluation, but it's not only undervaluation that should be your starting point necessarily, but you should also look for where the growth tailwinds are. So, for example, currently two areas which are actually not doing very well are exports and rural consumer. These two areas are actually struggling. Now, over the next 6 9 months, if the stocks do get cheaper in these particular areas, then you can bet on the fact that over a 3 5 year horizon, these particular spaces will actually make a comeback. Uh, Exports requires a global tailwind, and rural consumer, I think it's been 3 years since the pent up demand has been waiting, and I guess the trickle down effect from capex to consumer also tends to happen. If we go by the 2003-8 cycle, the capex boom started from 2002. It converted into a consumption boom sometime in the year 2005. So 3 years into the capex boom is when it becomes a consumption boom. So if we believe that the capex boom for this particular cycle has started 1.5 years back, I think a year down the line would be a great time to start looking at consumption oriented stories at the bottom of the pyramid.
Okay, that's a very good insight. So, would you say that this is the time when one should start accumulating stocks from the FMCG space, because those are the most underperforming sectors perhaps thus far, and the other space is the IT space. That's also into the exports or outsourcing. That also has been a rather underperformer. These two sectors, what would you say there?
No, so these are exactly the sectors, but I won't say this is the time to be accumulating stocks. This is the time to
Okay.
keep on radar, keep an eye out. We want to see the things turn. It might be so that for another 6 9 12 months, the things don't improve dramatically. In case there is any external event and that leads to further the stocks becoming cheaper, that would be a great entry point, because then we have the valuation comfort as well as a potential upturn in the cycle as well ahead of us. So right now, the upturn in the cycle is not very visible, and the valuations have not reached a stage where you can say that you know what, that come what may, I'm going to bet on these stocks. So both the things need to happen, and I'm suspecting that should happen over the next 6 to 12 months.
Okay. Ravi, the two things that worked very well between last time you came to us in August and now February is the auto ancillary theme, as well as the broader auto sector, as also pharma. It's the interest rate cut scenario working out within the auto space, and pharma of course has come out after a 5 7 year kind of a downtrend. Within these spaces, is ValueQuest Platinum placed somewhere, or these are places that you've avoided?
So, pharma overall, see, there are many buckets within pharma. Pharma and healthcare is not anymore a US focused generic play. There are domestic pharma companies, there are API companies, there are contract manufacturing companies, there are hospitals, there are diagnostics business, and there are some specialty niche businesses also. So, putting everything under the bucket of pharma might be missing the nuance. So, we are not very bullish on US focused generic companies which are very oral solid focused. That there is a cyclical revival over there, but that seems to be a very saturated market for us. So we are not very keen on that space. But if you look at whether it is the CDMO manufacturing space, I think that is a good space. There should be a lot of tailwind developing going forward over here. Then there are some niche plays available, whether it is some technology because of, let's say, the fermentation based API companies, or some very niche companies which are focused on healthcare areas, that would be a better way to look at it. Rather than taking a top-down call on the sector, there are some good bottom-up opportunities available in this space, and that we continue to like those.
Okay. When we look at the holding structure of ValueQuest Platinum, where you have somewhere like 1,200 crores in terms of AUM, what are the number of stocks and how are they distributed over large caps and mid caps in the first 10 as a percentage of AUM, the heaviest weights?
So we run a very focused and a very concentrated portfolio strategy. At the strategy level, we would be having roughly about 20-21 stocks, and almost 50% of the holding will be 45 to 50% of the holding will be in the top 5 stocks. So that is the kind of strategy we run, and we believe that kind of belief we carry in the companies that we own, and that comes from the kind of research rigor that we have. And we are very comfortable in our skins with holding that kind of concentrated portfolio.
Okay. And how would this be distributed across sectors, the top 10 stocks?
So financials is definitely the higher weightage. And within financial, as I mentioned, about 30 odd percent would be in the lending financials, about 15% will be in the non-lending financials. And then the second biggest weightage would be in the manufacturing / capital goods. That would be another 20-25%. So about 50 to 60% exposure to financials and manufacturing.
Okay.
Okay. Let me get one more question from our viewers at this point. This is from Dev Srivastav from New Delhi. He wants to know from you, what is the role of valuation when we see pockets like PSUs trading at very high valuations, but they are constantly moving higher? How does one really go about it?
See, valuation is an art, and honestly, in a 5-minute or 2-minute answer, I cannot capture the entire gist of it. But looking at the PE multiple is not necessarily the answer to the valuation question that you're asking. It depends on what is the kind of growth that is coming up ahead, what is the kind of outlook for the sector, what are the company level things that they are doing, which kind of increases the outlook for the company. All those things, perception plays a big role in the PE multiple of a particular company. But what drives that perception will give you a sense of whether that company is undervalued or overvalued. To give you a kind of an analogy, we look at what is the outlook, and as compared to that outlook, what is the valuation? Do the 3-year, 5-year scenario capture everything that is to be captured in the valuations? If not, then from this point on also you can make absolute returns in the companies. But you have to be very well aware of what that 3-5 year horizon is, what that 3-5 year scenario is, and what if that scenario doesn't pan out. Then you have to change course and make corrections in your portfolios accordingly.
Wonderful. That's the simplest way perhaps that anyone could have explained the way valuation has to be looked at in the current realm. There's one more space that is getting a lot of attention these days, and that is the insurance space. I wanted to understand from you the way LIC has come back after a long haul, the way New India Assurance, GIC Ray, SBI Life, HDFC Life, they've all been, soaring higher. Is there merit for long-term investor to really look at this space and the current valuations and prices to accumulate any of these stocks?
So see, there's a big financialization theme that is panning out in this country. Historically, we have all been, as I was just listening to Mr. Uday Kotak today in the morning, what he's saying is that we are moving from a saver-borrower model to a investor-issuer model. Essentially, what he's saying is that we are not saving our money and putting into banks in the FDs and deposits, but we are becoming investors and giving the money to the companies that want capital for expansion. So that's a big change in attitude that is happening. But what I'm saying is that money is moving away from physical assets, money is moving away from fixed income oriented assets towards more risk appetite oriented. And insurance is also part of the financial products basket, So some money will flow towards insurance as well. So there is a large tailwind that these sectors have in terms of growth runway. Second, for a period of almost 4 or 5 years, insurance companies did not perform. Post listing, they all listed at a very high multiple, and hence 4 or 5 years there was no performance. And second thing, there was a lot of regulatory headwind. Whether it is IRDAI or whatever, there was a lot of competitive pressure and regulatory push, which was leading to yields declining for them. There has been some abatement of that, and that is leading to the cyclical revival in the sector. So, a longer term secular tailwind, shorter term revival in the sector, and third, valuations becoming more reasonable is what is leading to the revival overall in the insurance sector.
Okay, so this was how we saw insurance working out. Uh, let's draw back to the auto space, Ravi. Record highs are being seen, and on the consistent basis on stocks like Tata Motors, Bajaj Auto. The new guys to join the rally are Maruti and M&M. And of course, we've seen laggards like Eicher and Hero Motors also perform. These are traditional sectors that at least I grew up with when it came to record highs in the broader markets as well. The autos have already and always participated. How do you feel when you look at valuations of two-wheelers, four-wheelers? Are these in for a long term from now on, or are we done for a longer period of time?
So see, valuations are no doubt factoring in a strong revival in the cycle, and we have seen that the cycle has revived since last 12-18 months. Of course, it varies whether it's a two-wheeler or it's a passenger vehicle or it's a tractor. The cycles are different for each of the segment, but post-COVID, there has been a good revival in the sentiment and also a revival in the cycle. But that has kind of played out more at the upper end of the segment than at the lower end of the segment. But if you look at the longer term perspective, India is going to be a big consuming nation, and globally there is a big trend away from gas guzzling cars towards EVs. But in India, that trend is yet to pick up. We don't have infrastructure in place, and the product portfolios are pretty solid. There is a premiumization trend that is playing out. There is an SUV trend that is playing out, and all that is being captured by few players. So there are only 4 two-wheeler players. There are only 3-4 OEMs in passenger vehicles. So in an upcycle, you have to look at the valuations also in the context of where we are in the cycle. If you believe that the cycle is going to peak in next 1-2 years, then definitely the valuations are very expensive. But if you believe that there is a much longer runway available for these companies, then valuations might be expensive and they can correct 10-20%, but there is not going to be any major value destruction over here. And that is how I believe we should be looking at it. So my belief is that we are still a young nation. We are going to consume a lot more. Autos are a play on that consumption story, and it has a long runway ahead of it, but it will have its cyclicality along the way.
Okay. And the defining feature of the last 6 months, Ravi, has been this superior risk reward delivery from the PSU pack. In the 2021 stocks that you hold within ValueQuest Platinum Fund, how many are PSUs? Has this rally sort of missed you by, or is this something that you still look forward to?
So the way we look at companies and the businesses is never that whether government owns it or not owns it. For us, it is about whether that business has a moat, does it have a competitive advantage, does it have a right to win. So from that perspective, if you see, we actually had a decent sized bet on PSU defense companies, and that has panned out very well for us because these are all kind of monopolies in their own right. While on the other hand, PSU banks is only a cyclical revival in the sector. The banks are basically consortium lenders, and they don't have, whether it is in terms of cost of borrowing, whether it is in terms of managing their balance sheet in the downturn, whether it is in terms of high quality talent, they are lacking in all those areas. So we don't prefer betting on PSU banks as an investment. It can be a tactical trade at best. But there are businesses like, without naming any company, but there is only one light combat helicopter and aircraft manufacturer in this country. There is only one company that can manufacture defense warships. So these are the kind of companies where the profit pool is protected, and the runway is still long ahead of us. So we like to focus on the quality of the company and the business rather than just valuations.
Very, very, explanatory way, the way you've explained this. I'm sure all the viewers are taking each and every line, noting it down in their notepads, because this marks for a great learning, even and repeated reading out of what you've said over here. Let me squeeze in one question from our viewers list then. This is of course with respect to the developments that have been taking place over the last fortnight or so. Nitin Verma from Mumbai wants to know, how can we predict events like Paytm and deal with uncertainties of regulatory issues and corporate governance if we have such stocks in our portfolio?
Good question. I think that's the burning issue today. Honestly, if you are on the ground and you do a little bit of channel checks, you do get to know which are the companies that are not following business processes, that are lax in their requirements. You will never exactly know what is that problem and if and when that action will come. But you can always put either too hard to understand or does not pass the smell test kind of a filter. So you will avoid those kind of companies. I think that much you can do. Nothing against any particular company, but if the practices have not been in line with the regulatory requirement, the compliance requirement, it usually shows up in aggressive business practices. So I won't say it is impossible to detect, but there are smell tests that you can apply and you can figure that out.
Ravi, when you look at how the markets have appreciated third quarter earnings, they've hit record highs on several indices, and that rally seems to be panning out well. But when you drill it down like you do in your research, which are the companies which have emerged showing sustainable competitive advantage, or where business models have scaled for the better?
So I won't name any particular company, Shelji, but what I will say is that usually, you can figure that out from their cost of sourcing, their cost of funding, their margins, gross margins can tell you how much value add they do. And if you do an industry level competitive analysis, you will come to know that this company is doing something extra. Why are their profits better? Why are their balance sheet in a better shape? Why could they not manage the previous downturn? So I'm sorry, I'm giving you a very generic answer, but that's how we would look to get to know if the company has any kind of a competitive advantage and whether it is sustainable or no. Whether it is that, again, you will have to do channel checks, do scuttlebutt, talk to dealers, distributors, and they will tell you, why this particular player is doing well or that particular player is doing well, who is gaining market share. So there is a lot of things that you can come to know by doing channel checks. In today's day and age, it is not that this information is not available even to a minority shareholders. With little bit of work, there is a network of investors out there, and they do share a lot of information amongst them. You can also get plugged into that and get information about how a particular company or an industry is doing. So lack of information is not something that's a hindrance, but the problem is more about there is too much information, and what is the right information to be focusing on. I think that gives an investor an edge today.
Okay. While you are not naming companies in particular, which is totally acceptable, what have been the disappointments in the third quarter as sectoral or thematic plays?
I think specialty chemicals is one place that clearly stands out, which has taken a bad beating, and not in terms of stock price performance. I'm actually surprised by the stock price performance, because the kind of quarterly results that are coming out, there's been total washout. where EBITDA and the profits have dropped anywhere from 10-12% to 60-70% in some cases. And just to give you an anecdotal, data point which will tell you that from 2020 to 2023, in the 3-year scenario, India would have added almost 60 billionaires. And out of that 60 billionaires, maximum were from the chemicals industry. Now, that tells you that what kind of wealth creation has happened in this space. And then at that point of time, people forget about all the risks, that it is a B2B business. We don't know which way the spreads are moving. We forget that China is still the big brother over here, and the anti-dumping duty goes away at some point of time. Chinese dumping has started again. So all these kind of things have now come back to bite chemical space, and I believe it's still not the time to be betting on the chemical space.
Okay. What about then other commodity spaces like metals, for example? What is your thought here?
So, see, in a metal or any particular commodity, it usually the cycles are driven by the supply side. It is not the demand that drives. Demand is usually pretty steady, and it moves at a 4, 5, 6% kind of gradient for a long period of time. But it is the supply, oversupply and undersupply situation that creates the cycle in the commodity. And without getting into any particular commodity like steel or anything, but I believe that there has been a dearth of investment in the steel sector for a long period of time. And if that is the case, then at some point of time, the demand will start surpassing supply, and we'll have the capex cycle starting again in the steel sector.
When I look at the portfolio allocation between ValueQuest, Platinum, I find about 15% devoted to building materials, Ravi. This is the second highest weighted counter in terms of allocation of funds. How are you looking at this theme within the real estate space? The makers of sinks, the makers of tiles, this beautifying of homes post-COVID. People have bought large homes and they are beautifying it, spending crazy amounts. How is this getting reflected in your portfolio?
So just like I was mentioning the cycle about the oversupply and undersupply, real estate for a period of 2014 to 2021 saw almost 40-50% of the developers going out of business. Many things happened. GST came in, demon happened, RERA was implemented, COVID happened. That kind of pushed a lot of competition out of the real estate sector. So real estate sector revival has happened post COVID, but most of it has been concentrated at the higher end of the segment, the premium segment really. It has not been so much at the affordable end of the segment. Now, we actually prefer playing real estate through building materials because there are a lot of changes that have happened in the real estate sector, but still there is a kind of a hint of a cash dealing and something being off the books. So the corporate governance standards are evolving in this particular sector. I won't say they have evolved completely yet. So that is why we prefer playing it through the building materials sector. And that some segments are doing well, some segments are still not doing well. But we believe that that the pent-up demand is a lot, and there will be a revival in next 6 to 12 months at the bottom of the pyramid in terms of affordable housing also.
Okay.
Because as we see interest rate cuts, I think that demand should also revive.
So you look at the allocation, it's almost at par with NBFCs, almost 20%. Within building materials, would you have more than 5 stocks, or is this again a very concentrated portfolio?
So building materials, actually some of the building materials are a play on the infrastructure as well. For example,
Yes.
if I were to give you an example of cables and wires, the cables and wires go inside a home as well as they go inside a factory, they go inside a solar plant, wind plant. They go, a lot of it is towards the large infra projects that goes. So the driver for some of these companies have been more infrastructure rather than real estate at this point of time. So it cannot be said only that it is a revival of real estate that is leading to the revival in the building materials company. So that is what is leading, infra is what is leading the revival in some of these companies.
Okay. Let me squeeze in one more question then. From Bengaluru, Deepesh Sahu wants to know what are some of the biggest risks now to watch out for in the current markets? Of course, we've had a stellar run, but what next? What could derail the markets from here?
So usually the risks in the markets are the one that we cannot see, and as we start rising further and further from here, there is a possibility that we are throwing caution to the wind. We will forget our entry point valuations, and we'll also forget to put the quality filter in, and some of the profits and profitability in some of the sectors are going to be cyclical. So at some point of time when the cycle turns, some of these profits will prove to be unsustainable, and that is the risk that we are carrying. Going lower down the quality curve, compromising on the entry point of valuation, and buying into profits assuming they are sustainable and they will grow from there.
Well, that's a wonderful explanation. Ravi, I also noticed that about 10% of your portfolio is in cash. Is that a strategic allocation, or is this something which is work in progress, waiting for valuations to become juicier still, or for you to lose your patience and then buy the momentum?
Yeah, no, we don't lose patience. And our calls are never on the market. We never don't take a generalized call on the market that markets are expensive, let's take a 10% call. Usually it's that one particular company or something has gotten really expensive, and we have kind of exited one or two companies, we have exited those positions, and we are still waiting until we come up with new ideas to deploy, and that results in cash positions, but it is not a call so much on market.
Okay, fair point. I mean, you both profit, that's really good. And a couple of final questions on the overheating of the SME sector as also IPOs. Are you applying in some anchor allotments, or is that something that you stay away from?
No, I think SME, honestly, companies are coming to raise 15 crores, 20 crores, 10 crores, and the kind of bets that you can place in that is 1 crore, 2 crore. I think there's a lot of fun and games happening over here. This is a allocation game, and I think we should be very, very careful. If there is one area where I would advise investors to be cautious about, is this area. Right now, nobody is looking at the business fundamentals. People are just putting in money because you get a listing pop. But at some point of time, this cycle will reverse, and at that point of time, there will be no exit. So, and this reversal can be driven by a regulatory action, or it could be just driven by overall market peaking out. So, but at that point of time, there is no exit. So you will have to be. It's okay to take some money off the table ahead of the curve rather than trying to maximize it.
Okay, that's a wise advice coming in from Ravi for all those investors who've been feeling the FOMO from investing in those listing gains and that are enticing from the SME platform per se, for sure. And even now we are seeing at least a slew of IPOs come about almost on a weekly basis. There are at least one or two companies that come in, and every time we hear people just asking, okay, which is the best IPO to invest in, because there is a thought process probably that you make more money by listing or getting an early entry point in IPOs rather than in secondary market. What would you explain to viewers? Is that really true, at least in today's day and age, or has that era passed by when people would really make good amount of money by investing in quality IPOs?
See, for us, IPO investing, whether it is SME or any, is more exception based investing. As a rule, it is probably overpriced. Finally, the returns that you make are based on the fundamentals of the company, based on the valuation that you pay for it. And if you are overpaying and not taking a look at the fundamentals, this will come to bite you back at some point of time. Right now, it is all fun and games that is happening. So I would say, don't think of yourself as a genius that you have figured out how to make money in this market. There is nothing that changes in the market. We have seen this story pan out in the past also many a times, and it's usually the retail investor that is left holding on to the bag when the music stops. So my advice to you would be, if you are in that category, just take some money off the table, ensure at least that whatever capital you put in is taken out, and then you can let your profits ride as long as you feel.
Okay. Uh, Ravi, one of those themes that don't seem to have worked out well in the market was this PLI scheme linked towards, white goods making, making of mobile phones, etc. This was really a hot ticket item about 2.5 years ago. It doesn't seem to have worked its way out into the system at a time when manufacturing has really done very well in terms of stock picking. Has this been a disappointment for you?
No, I think the valuations of these companies ran up a lot faster than you and I could have imagined. Some of these companies were 7, 8, 10 baggers in a span of 2, 3 years after post listing. So I just feel that people are catching on to a new theme and making the stock overpriced in a very short period of time. The longer term theme might still be very attractive, and some of the companies that we are talking about will become huge manufacturing giants out of India. But this ride is going to be far more volatile and cyclical because these business operate on very thin margins, and a little bit movement here and there leads to margins disappointment. So that is where I would caution that from a longer term, this theme still looks good, but you still have to time your entry, and you have to understand what that this is not a short term trade, and you're investing for the long term. Be with the better and the larger companies that have shown demonstrated ability to scale up and good execution. Execution is the challenge over here, because if you can get caught up in a wrong order, it can lead to your profits getting washed out.
Okay. When we were talking commodities, there was one more space in my mind to ask you. I forgot that time, and that is the energy basket. When was the last time we used to talk about MRPL at least thrice in a week, showing double-digit returns on a single intraday basis? ONGC, Oil India, IOs, you talk about all three OMCs, they are at record high levels. What is really happening in this space at this point in time? What is your own thought process when it comes to investing here?
No, I think they have been long ignored. Probably it's been like, as you rightly mentioned, when was the last time we spoke about it? So it's been a gap of 13, 14 years since anybody even spoke about them. And that tells you that, they have been long ignored sectors. And the valuation had reached such crazy levels on the downside, like 2, 3, 4 multiple for a lot of the
True.
companies, even though the cash flows, they were cash flow making companies, and their cash flows have now started growing because of the kind of capex that government is putting in. So there is a legitimate and logical reason for these companies to start doing well, but one has to understand the difference between what is a trade and what is an investment. There are some companies that you can own for a 2, 3, 4 year period, not for a 5, 10, 20 year period. So I would believe some of these companies fall in that kind of a bucket where there's a good money to be made from 2, 3, 4 years perspective, but probably those companies don't have any right to win over a 20, 30 year. They are not the cash flow compounding machines that we expect them to be.
Okay. Our last question, Ravi, and we've saved the best for the last.
I hope it is really the last question.
Yes, it is. See, we got you after 6 months, and between that time, the markets have really appreciated. So our last question is, between now and 6 months later, when you come again in August of 2024, where do we see the markets? We'll be over with the main hurdle, which is the national elections by then.
Markets will be right here and I will be right here. I have no way of telling you what the index level will be, but I can tell you if we are going towards a $5 trillion economy in 27, 28, and our corporate PAT to GDP is going to rise from 4.8, 4.9% currently to towards 7, 7.5%. I think there is a lot of money to be made. Forget index, lot of action has been happening outside of index.
Yes.
Focus on identifying good business opportunities and you will make good money. There will be volatility. It is the point A to point B journey is not going to be a straight line. It's going to come with a lot of moments that is going to test your conviction, that is going to test your mettle. So those will be the time. The actions that you take when everything seems lost is going to determine how much wealth you make. markets volatility is a feature and not a bug in the market. And since markets have been not very volatile for the last 3 years, expect volatility going forward. But the longer term wealth creation story still remains intact.
Wonderful. With that, Ravi, thank you so much for your time, and we wish you the best with the ValueQuest Platinum and the other 3 schemes that you mentioned. May your AUM double both in terms of profit as well as new inflows. Thank you so much for your time.
Thank you so much.
Thank you, Ravi sir.
That, ladies and gentlemen, was Mr. Ravi Dharamsi. He's the founder and MD of ValueQuest Investment Advisors. The broad themes that he's been looking for in his portfolios is the fact that we still don't have an overheated market as far as small caps and mid caps are concerned. That is his thought process. If you look at themes that he's investing so far, it's in affordable housing, NBFCs, general insurance, the energy transmission and the transition phase, as also he's only looking at a couple of sectors from a distance, such as exports and rural spending, as well as IT and FMCG. Here, the prices haven't corrected as much as he would have hoped to put in a buy trade. But that, ladies and gentlemen, is how Ravi Dharamsi is navigating markets from now on. Thank you so much for your time, for watching us at Market Masters. We hope you enjoyed the show as much as Sakshi and I did in interviewing Ravi Dharamsi. Stay tuned with Business Today for all your financial news needs. Thank you so much.
Thanks so much.
Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe from multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines and many other sectors.
Nifty Auto Index. Sakshi, there is a blowout on that one. Needless to say that it is at a record high, and this is the 3rd day of gains. The Nifty Auto Index at the moment